There's certain characteristics of a banana republic. First of all, Banana Republic has trillions of dollars in debt. Before I came on the show, I pulled up the data about the total non-financial debt as a percentage of GDP in 2007. So Banana Republics are just swamped in debt that the central bank has to monetize. That's one characteristic. In 2007, we had $33.73 trillion in debt. Today, this as of Q2 of 2025, it's $77.95 trillion. So when people tell me, well, we've deleveraged as an economy, blah, 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 and the consumer's doing fantastic, I'm looking at the aggregate. So you're talking about consumer debt, household debt, corporate debt, and that includes things like private credit, which didn't even exist before, buy now, pay later loans, student loans, auto credit. When you add it all up, we're taking out the debt from the banks, it's $77.95 trillion. So if you say, well, Mr. Pento, you're just data mining because you're just picking a nominal number, I'm going to do it as a percentage of GDP. I always do that just to tell me that I'm looking at the data honestly. As a percentage of GDP, it was 229% in 2007, and today it's 257% of GDP. So how the hell can anybody get on television with any self-respect and not go to the Z.1 data and pull out the total non-financial debt of the United States pre the global financial crisis in nominal terms, 33 versus 77, and then look at it as a percentage of GDP and say, well, we're more ever over-leveraged now as a nation than we were back then. So we're more prone to an interest rate spike than we've ever been before. And you mentioned very succinctly, it's not just the level of debt that's the problem. It's the fact that cash flow has been destroyed because inflation has wiped out the purchasing power of the middle class. Yes, it's true. Household debt was 100% pre-GFC, and now it's about 70%. That is down. Even though 70% isn't where it was 20 years ago, it's still higher. It's the cash flow to service that debt that's gone. That's so crucial to understand. I'm not trying to paint a picture here of total destruction. What I am trying to say is keep your damn eyes open. Do not sit with your target date fund and your 60-40 portfolio and say, well, look at the last few years. Things have gone great. Well, yeah, we have a strategy here that makes money in bull markets too. But what is your strategy to identify when these three bubbles burst? Credit bubble, as I just laid out the data, the real estate bubble we just talked about, and we also talked about the equity bubble. Three bubbles existing concurrently. When they burst, and they will burst concurrently because the credit markets will fracture, like they always do, because we're over leveraged. When that happens, can you identify it and what do you do? Can you identify it early enough and can you react to it to save yourself before this market drops once again 30, 40, 50, 60, 80% like it did? I was thinking about an interview I saw today on Bloomberg. The individual was asked about how much better the corporations are now than they were in 2000. In 2000, we lost 50% of the value of the S&P 500. And in 2008, we lost 50% of the value of the S&P 500. Well, yeah, we do have earnings now. We also had earnings in 2007 as well. But here's the function. The market is as narrow as it could possibly get with 7 companies leading the S&P 500, market cap weighted. And the way the target date funding works is that, you fund your 401k plan, your IRA, and that money goes into the S&P 500. The cap weighted gets most of the funds and they get even higher and their averages go higher and higher. That's the way the system works. But when we enter a recession, because the business cycle has not and cannot be repealed, it's like trying to stop an earthquake. I say, let's have the tremors occur so we avoid the big one. We have avoided tremors since 1987, or tried to avoid tremors. And we built up this massive potential energy in the financial system for an earthquake. When it happens, when you have a recession, the money, I don't care how necessary AI is going to be. It's a watershed technology. It's extremely great for productivity. But I also love Cisco systems in 1999. I love the internet in 99 and 2000. Switchers, routers, and fiber optic cable, all necessary part of a very necessary technology. But when the recession comes, the capital, the cash flow from these corporations to buy chips from NVIDIA will dry up. It goes away. So on a second derivative basis, at least, you're going to see their valuations crash. So you're going to see, instead of the earnings growing at 40% a year, they go to 10% a year. And just that alone, I'm not talking about an all-out depression where you don't buy any chips from NVIDIA, but just the rate of change on a second derivative basis will cause these companies to absolutely crater in value. And because they're cap weighted, and that's where all the index is based off of, you're going to see the indexes plunge. What is your protection? What are you looking at to identify that so you don't get caught in that destruction? You better have an algorithm, you better have a process, or you're going to be postponing your retirement, if not canceling it altogether. stock ownership among American citizens has never been higher. It makes sense because people chase. They have something called FOMO. I know fear of missing out. So if you have a prudent financial advisor who said, hey, you need to have some ballast in your portfolio, maybe some protection, have some precious metals, have some bond exposure on the right duration on the yield curve. Yeah, but the S&P 500 went up X% last year. Well, I got to beat S&P 500. So everybody has, instead of having 60-40, which I hate that, set it and forget it, portfolios don't work. But having some ballast or offset in your portfolio from a crash, they don't want it anymore. They just want all stocks. And it doesn't matter how old you are. They want to be 100% in equities. This is what the damaging setup is. But, the mantra has been, well, the Fed and the government always has your back. Well, I can't think of a government that has more command and control over your finances and over an economy than China. They control the amount of lending, they control interest rates, it's plenary authority. And their Shanghai Composite Index is still down about 40% from where it was in 2007, the last time I checked, which is a couple of months ago. Japan doesn't have plenary control over the economy, but they do have plenary control over their interest rate complex, all durations. Do you have 35 years to wait to get back to even in nominal terms? And in real terms, you're still way off. I mean, nominal terms. No. It took Japan 35 years to get back to where they were, which is 39,000 on the Nikkei Dow. But that's in nominal terms. What about the inflation associated with 35 years of waiting for that to happen? So the point is to make money in nominal terms, but also in real terms. Now, if you're going to get sucked down in this inevitable debacle, which is bound to happen, I call it the great reconciliation of asset prices, it has to occur. Well, how do you protect yourself? What are you looking at? I look at things like the copper to gold ratio. I have an algorithm that I created. I have a 20-point model. I look at financial conditions. I look at yield spreads. The arcane parts of this market that let me know when the cabal of individuals that actually run this planet, they know when things are about to crash. And you have to know what they're looking at and what they're doing to protect their assets, because they will do. And it's a legal way of me following that path. So it's important to understand exactly where the economy is. And I look at the second derivative of inflation in the context of growth in the economy. That's how I manage money. And I have 5 sectors that range from deflation all the way to intractable stagflation. And if you can find out where you are in that spectrum, then you can best know what asset classes, so what stocks, what bonds, what commodities, what currencies to own, and which ones to short, because I run a long-short strategy. I use ETFs, so it's great for retired people. The most important thing I can leave you with is that passive management, which has worked very well for these few years, has anesthetized and through inculcation, through all these years, has preached that there's nothing that could ever go wrong. The government has your back. And I've been doing this since 1991. I've seen an awful lot, not just in this country, in other nations around the world. And the government doesn't have that kind of authority, skill. They are not adroit enough, knowledgeable enough, or well-intended to prevent you from suffering the consequences of the business cycle. And we're going to have a recession. It's going to be cataclysmic because it's going to be one we've never seen the intensity of what I see a recession, which is marked by stagflation, from which the government's hands will be mostly tied because everything they do is going to make the situation worse. It's going to exacerbate that long end of the bond yield curve. And if the Federal Reserve assents to buying all of long duration bonds and treasury bonds to keep that yield curve down, I have to say, are you also going to assent to buying corporate debt? How about municipal bonds? Where does it end? How many trillions is the government willing to print? You're going to talk about revolution in this country because the inflation that's going to come from that will be overwhelming. It's already causing, they say it's a K-shaped economy. So the people in the top 20% are doing fantastic with their houses and their equity holdings. It's keeping consumption going, but that's going to falter. And you just cannot have a viable nation without a healthy middle class, because those are the people that do all the work. Those are the people that actually produce things. Everybody can't be wealthy and everybody can't be dirt poor. There has to be a viable, healthy middle class. And if they assent to buying everything, every bond ever created, every fixed income instrument to mask and put a veil over the inflation that they've created, they're going to make inflation run rampant and destroy the middle class and destroy this nation. Well, the unemployment right now, I think it's 4.3%. If you're looking at the U3 unemployment rate, U6 a lot higher. people who are discouraged workers who just say, I'm not in the labor force, but I would be if I thought there was a chance to make a decent living from a job. So you're looking at the Federal Reserve that consists of labor market economists. You think they have all these models, but the only model they really care about is something called the Phillips curve. And that mistakenly believes that inflation comes from, too many people are working and that increases demand. It totally overlooks the fact that people working are actually producing things. So there's more stuff to buy. And I don't know if they're stupid, but I never heard anybody say, inflation comes from printing too much money, and that's exactly what we've done. We took the Fed's balance sheet from $700 billion pre-global financial crisis in 2007, and we ramped it up to $9 trillion for no damn reason, because we were so worried about having people that were in power would lose power. So we had to print so much money and hand it out to people that people would feel good. And that worked until inflation now became the salient issue. Inflation now supersedes anything, in my opinion. It's the most important metric that we see. I don't think the unemployment rate is going to skyrocket because, I look at what corporations are doing. They're not hiring, but they're not in mass firings yet either. Because again, this is a problem. The labor market statistics, and you won't see it so much in the BLS data. You see it in the ISM data. You see it in the ADP report. Private source data shows that the labor market is not strong. It is very weak. I'm not denying that. But it's a function of immigration more than it is mass layoffs. But the point I'm trying to make here is the Fed, which is made up of a bunch of Phillips curve economists, they are looking at the rising unemployment rate and the no nominal number in the non-farm payrolls report as a sign of oh my gosh, we are heading for destruction in the economy. It's a false signal in the short term. It's not borne out by any of the arcane stuff that I look at, things that really matter. If the economy was falling off a cliff, you would see high yield credit rates boom in price. In other words, the people who know would sell junk bonds and short junk bonds. Price goes down, yield goes up. And what do? They'll buy short-term treasuries, and that spread would widen. It is not widening right now. And I never see Powell say, we're looking at market indicators to let us know how the economy is doing. So instead of saying, GDP growth is running at 3.3% in Q3 of this year, 4.3% unemployment rate is very, very low historically. We see credit spreads that are extremely tight. Financial conditions are very easy. The home price to income ratio is at a record high. Total market cap of equities as a percent of GDP is the highest it's ever been in history. And inflation has been above our target for 53 or 54 months. Why are we cutting rates? We're cutting rates because we're myopically worried about the labor market. And you're going to get a series of rate cuts coming. So we're going to get a much lower Fed funds rate. I am predicting that the long end of the yield curve, outside of the government shutting down, which could happen very quickly here, but I don't think it lasts very long. But outside of that, I think long-term interest rates are going to soar higher, not just go up a little bit. They're going to jump above 5%. Because listen, if you have 3% inflation and you have 2% nominal GDP growth, that's 5%. Your 10-year note should be around 5% or maybe even a little higher. It doesn't belong at 4% and where it is right now. So long-term interest rates are going to rise. That's going to act as a governor or a depressant on economic growth. In other words, stagflation is happening now. I think it's going to happen in the future. And going out a year or two, whenever we get the business cycle to roll over, and it will, and you will get that organic destruction of the labor market, not just from the lack of labor supply. It'll be labor demand just gets destroyed. You'll see unemployment rates tick up. You're going to again see ZERP. You're again going to see helicopter money. And I think you're going to see runaway, intractable stagflation like we've never before imagined in this country, which I think will be devastating for asset prices, including real estate and including equities.